My name is Ladell, and I've had the pleasure of serving as the Chief Financial Officer and Chief Investment Officer of Newark since August of last year. I come with over 20 years of financial services experience in the U.S., Sub-Saharan Africa, and Europe. I have a BA in economics and an MBA from Harvard Business School. BA is from UNC Chapel Hill. I'm a proud Tar Heel alum. And I say all that because I have a lot of experience with financial statements and understanding of financial statements. At Newark, with my passion for trying to improve society through business. And so the main reason that we are here today is recent data has shown that many of our local businesses do not have basic financial statements. And as a result of that, you are missing opportunities to attract capital. But beyond that, it also means that there's a reasonable chance that many owners may not actually understand what is happening in their business. So the main objective of today's discussion is to make sure everyone understands what we mean when we say financial statements, and to ensure that in one form or another that businesses are preparing them. And here's a case study of the reason why. So I'm sure that many of you heard of the City of Newark United Way Small Business Grant Fund, which was awarding small businesses up to $10,000 to assist with COVID relief. I'd like to just share some data of what has transpired. So there were 1,200 people who attempted to fill out an application, approximately. Of those 1,200, 460 people did not finish the survey. Then you had another 280 people who were disqualified. So we ended up with about 450 people that completed the survey. But at the end of the survey, it required the business owner to provide, including financial statements. As a result of that, we ended up with only about 160 fully completed applications as of last week. Now, there have been some extensions to try and help people put in more information, but we believe from the data that we've seen that the reason why we started with an audience of 1,200 and we're ultimately down to 160 completed applications is because of missing information, of which the chief of those was financial statements. And as a result, there's probably $1 million of capital that could have been deployed earlier to help small businesses if things like financial statements were in order. So that is the reason why we're pulling that session to get this session together today, and we want to talk about financial statements. So the essential statements, basically you can put them in two buckets. You have your financial statements, which is the subject of the conversation today, and then you have tax statements. For the financial statements, there are basically three primary ones and then kind of an additional statement which is often included. Those are the income statement, the balance sheet, the cash flow statement, and then the fourth statement, which you will often find, is a statement of shareholders' equity. And we're going to talk about these during the presentation. On the tax side, there's a range of different forms depending on your type of business. That's not the subject of today's conversation, but they're very important and they also serve a different purpose. The punchline of all of this is that your statements are basically your business on paper. You must always have them, because not having them is in many ways kind of almost saying your business doesn't exist to certain audiences. So let's start with the income statement. Here are the key things that you need to know about the income statement. The first is the income statement basically measures performance over time. So it describes what happens to your business over a period of time. That period could be 1 day, that period could be 1 month, it could be 1 year, and so on. And it answers a couple of key questions. For example, did your business make sales? Did you generate revenue? And then how did you spend that money? And when you add those two things together, it answers the ultimate question, which is, are you making money? So in other words, the income statement basically allows the reader to assess your capabilities, which is why you'll hear people say things like, Jerome's trucking company made $50,000. Now that $50,000 could be revenue, it could be operating income, it could be net income, but it gives the reader an opportunity to assess your capabilities. Now, let's take a more detailed look at the income statement. For most businesses, there's a couple of key components, and it all starts with sales, and it ends with net income, which is your profit. So sales basically is whatever you sold times the price, right? Price times quantity sold, that is your revenue. Then the first deduction that you would make from that is the cost of your direct materials and your direct labor. Emphasis on the words direct, because when you subtract the cost of goods sold from sales, you get something that is called gross profit. That is personally my favorite line item, because gross profit basically speaks to your business's ability to add value to what we could call raw materials. And even if that raw material is your personal intellect, meaning that you give someone advice, the difference between how much it costs you to give that advice and how much you sold it for is the value that you basically added. Once you get to gross profit, you deduct what you would call operating expenses. Those are basically your overheads, like your rent or your secretary or your insurance. Those are costs that you incur to run business. When you deduct your operating expenses from your gross profit, you get to operating income. This is the first test of whether your business makes money, because operating income basically means, does my business make money from operations? And the trick is that your gross profit must obviously exceed the cost of your operating expenses in order to determine whether or not your business is actually going to make money. And I'll give a case study at the end of this about a situation I encountered. The next line item is interest income, interest expenses. So that is basically either the cost of financing your business because you have a loan and you have to pay interest on that loan, or you have cash and you generate income from your cash. Those two are financing incomes. So they're not related to your operations, but they are either a result of your operations or a necessity to your operations. However, those are tax deductible or they are taxable because you add the interest income or deduct the interest expenses from your operating income and you have your pre-tax profit. This is how much you have earned before you have to pay taxes. So then we obviously understand taxes, what you owe to various governments. You deduct that from your pre-tax profit, and you have your net income, which is what profitability did your business generate. Now, out of this profitability, many businesses choose to pay themselves a dividend. A dividend is basically money that you distribute from profits. It is separate from if you pay yourself as a business owner a salary. Yes, you've taken money out of your business, but a dividend is what you pay when it comes out of profitability. Now, I'm going to give kind of two interesting examples from my experience. So I worked in private equity for many years, and I had a friend who was asking me to come and look at a cocoa business in Nigeria. Now, the cocoa business, he basically told me it was a great business, but it had a lot of debt. And I was kind of wondering, well, okay, well, if it's such a great business, why does it have so much debt? So we go to visit the company, and we do the factory tour, and I asked them for their financial statements, and they didn't really have any. So then I just said, well, why don't you just kind of tell me how much do you make in revenue, and then how much does it cost to run this business? So to fast forward on the story, we basically calculated gross profit. And I had to deliver the unfortunate news that essentially they were not even adding enough value to the raw materials to make money at the gross profit level. So in other words, the reason why the business had a lot of debt is for some reason lenders were willing to support it, but they were never going to make any money because they weren't able to add enough value to the basic raw materials to even generate gross profit. I had another scenario where we invested $80 million into a biscuit company. And the biscuit company, really good company, great products, well known with consumers, but the moment after we invested, the entire market collapsed, almost kind of akin to what we have going on now. And the business owner, when he gave us the report to the board, he basically said, well, we're still making money. But when we looked at the financial statements, we had to explain to him that we were not making money. The operating income was negative. But what was positive was the fact that we had almost $80 million sitting in a bank account that we had not deployed yet, and that had generated interest income and had resulted in profitability. So yes, the business made money overall, but not from the operations. We were just generating interest income, and we didn't need a company to put a money into bank account to generate that profitability. So I gave those two examples to highlight to you why it's important to have an income statement and to understand the components of it so that you can make an assessment of what's happening in your business. The next statement that we're going to come to is the balance sheet. So the balance sheet, unlike the income statement, gives your status at a moment in time. So remember, the income statement covers a period of time. The balance sheet gives your financial position at a moment in time, such as the end of the month, the end of the year. The balance sheet basically has a left side, which are your assets, and your right side, which are your liabilities and your equity, and they must always match. As a former investment banking analyst, I cannot tell you the amount of hours that young people on Wall Street stay up every night working on financial models, trying to get the balance sheet to balance. It must always match. If you see a balance sheet and the left side does not equal the right side, something is wrong. It must always match. And the balance sheet is critical for people such as lenders, because when they look at your balance sheet, they're able to ascertain, well, how much cash do you have? How much debt do you have? How much inventory do you have? How much assets do you have? How much have people invested in your business? So the balance sheet basically informs the reader of your financial strength or your worth. So you'll hear people say when they look at a balance sheet, Lola's Pharmacy has $50,000 in assets. It's basically a way of saying Lola's Pharmacy is worth at least $50,000 because it has that much in assets. Drilling further into the balance sheet, I presented a very basic summary of the components that are in a balance sheet. Let's start with the left side. You basically have assets that can be put into two broad categories: current assets and long-term assets. Current assets are basically assets that can be used in a period of a year. So it includes things like cash, inventory, accounts receivable, because you expect these things to change dramatically in the course, of a year as you run your business. Long-term assets are things like investments. So you bought a piece of property for your store. That is a long-term investment because you plan to be in the store for multiple years. Similarly, you might have other investments like vehicles or something like that. Those are your long-term assets. And the sum of your current assets and your long-term assets creates your total assets. And that is the left side of the balance sheet. Now we'll go to the right side of the balance sheet. That basically has two components. Your liabilities, which are basically things that you owe, such as you might have short-term debt, you may have financing from people who provide you with inventory, you might have a long-term debt, such as your mortgage. The other part is your shareholders' equity, and that is, in summary, how much capital has actually gone into the business, either because you invested it or you've made money and you've left it inside the business in the form of what's called retained earnings. So put another way, the left side of the balance sheet is basically what I own. The right side of the balance sheet is how did I pay for it. So your liabilities.
Okay. And the right is in Minnesota.
Vanessa, I think y'all need to the help with our music.
All right, thanks.
Okay, just a reminder for everyone to stay on mute until we get to the Q&A session. So just to repeat, the left side is what you own, and the right side is basically how you paid for it, which is why the left side, total assets, must equal the right side, which are total liabilities plus shareholders' equity. The next statement that we're going to go to is the cash flow statement. I personally believe that this is the most important statement for a small business owner particularly, because cash is life for a business. Cash is your oxygen. The more cash you have, the more you can do. The cash flow statement, like the income statement, shows what happens to your cash over a period of time. So again, 6 months and 1 year. And as a result of that, it shows how you basically manage your cash from period A to period B, just like how you might balance your checkbook or your personal money when you get paid on Friday and then you use your money over the next 2 weeks and balance, and you ultimately get to the amount of money you have left. It's the same concept. But the reason why it's important for a business owner is it gives you a sense for, well, how much cash is my business actually generating? And how much cash am I actually spending? And how much cash did I get from other options, like maybe I didn't earn the cash, but I borrowed it or I raised it from investors. So as a result, the cash flow statement basically helps connect the income statement to the balance sheet. It's important, again, for a business owner because the cash flow statement is telling you what's happening to arguably one of your most important assets, which is your cash. But for a reader, it informs the reader of the likelihood that they're going to get their money back. Because in order for you to pay off the loan or to give money to investors, there has to be a pot of cash that is generated to service those liabilities or those ownership interests. Now, the basic cash flow statement, it can be done in 2 ways. And I'm going to describe the 2 ways because you may see both, but the one on the left is what is most prevalent for small businesses, and it's what we're going to focus on when I show an example. The cash flow statement is, or the presentation on the left is what you would call the simple or the cash-based cash flow statement. And all you're doing is following the money. So money comes in, I track it, I write it down. Money goes out, I track it, I write it down. Money comes in from sales, that is an inflow. Money goes out for bills, that is an outflow. Money comes in or out from loans, or I raise money from investors. But you basically track all of those transactions, and you are essentially doing a very simple cash flow statement. And it's easy to do if you track everything. If you don't track everything and you have to go back and look in time to see what happens, it gets to be a lot harder because you might be missing a statement or you forget something. I actually recommend for small businesses that you do this daily, but certainly weekly, because when you do it daily or weekly, you're able to notice trends. And when you notice trends such as, well, every month I pay this amount in rent, or every month I pay this amount in payroll, it allows you to start forecasting what's going to happen in the future, because you will know how much cash do I have today, how much cash am I likely to earn over the next week or 2 weeks, and what are the expenses that I know are definitely going to occur. Because with that, you can actually begin to think in the future, what is going to happen to my business? Now, the second one is what you call the indirect method. The indirect method is useful because it basically helps break down where cash comes from. Does it come from operations? So operations meaning I made something, I sold it, I got cash. Does it come from investments? So I owned a car for my business, I no longer needed it, I sold it, I got cash. Or did it come from financing? I borrowed money or I raised money from investors. The indirect statement is usually derived from financial statements. I personally think that an indirect financial statement is hard to do on a daily basis or a weekly basis, which is why I recommend the simple or the cash-based statement for most small businesses. But an indirect statement is good to try and do at the end of a period when you want to step back and take a look at your business and figure out, well, how did I actually generate cash from those three categories? Now we're going to come to the last statement, which, as I mentioned, is kind of the optional one. Sometimes you see it, sometimes you don't. But the shareholders' equity statement basically talks about what is your worth at a moment in time. It is basically the bottom right corner that we talked about when we had our balance sheet. So I don't know if you'll be able to see my arrow. I can't see it. But this statement called shareholders' equity when we were looking at the balance sheet. So that basically tells you, well, what is the value of this company when I deduct the amount of money that I owe to other people? But it also, if you flip that on its head, it basically talks about how much of your funding comes from equity investors. That could be either money that you put into your company, money that other investors gave you, or money that your business generated and you left it in the company, which is called retained earnings. I think it's personally useful to know how much value has actually been created in the business, because it gives you a sense to say, well, if I started a business with $2,000 and the business made $2,000 and I left all of it in the company, then I know that the money, the value that I've created, half of it came from my initial contribution, the other half of it came from money that the business generated. The last thing kind of goes back to dividends. So you'll recall when we spoke about the income statement, we discussed that if you make a profit and you share some of the profit with investors, that is called a dividend. That is also captured in your statement of shareholders' equity. So we won't go into further detail on it, but the statement of shareholders' equity is something that you may see, and it basically informs the reader of your net worth. Net worth being different from total worth, because net worth basically deducts the amount of money that you owe people. Just like if you owned a house, if your house was worth $100,000 and you have a $75,000 mortgage, your net worth in the house is $25,000. because if you sold the house and got $100,000, you have to pay off the bank for that $75,000, leaving you with $25,000. The very same concept in the balance sheet for a company. So I hope that you would have gathered from my comments that basically all of these statements are connected. The income statement influences the balance sheet influences the cash flow statement, and round, which shows how the relationship exists between these statements, with the main concept being the income statement and the cash flow statement cover periods of time. The balance sheet covers a moment in time. So now we're going to look at a very simple example of a balance sheet that I got from the Small Business Administration website. The most important thing is the left side equals the right side. So you'll see at the bottom of the balance sheet, the total assets are $68. The total liabilities and owner's equity is also $68. Now let's look at how this balance sheet is divided. We can see that on the left side, they have current assets of cash, which we talked about, accounts receivable, and in this case, they bought some books and they have some coffee. I'm assuming that books and coffee are the inventory, and those are the current assets. Now, on the fixed asset side, they have a coffee maker because they're going to use their coffee maker over time, and they have depreciated the coffee maker because presumably the coffee maker is declining in value over time as it gets used up. That's the concept called depreciation. But the total of all of that is those assets are worth $68. Now we can go to the right side of the balance sheet and figure out, well, how did they pay for that $68? Well, we can see that they have something called a notes payable. So that's a loan. So they borrowed $29 from someone. And we can also see that there's equity of $15. So that means that someone invested $15. And then in their previous year, they made $24 and they left the $24 in the company. So the business has total assets of $68, and it was financed basically with notes payable. So they borrowed money of $29, they invested $15, and they made $24, which we know that they must have recycled to put back into the business because it's on the balance sheet, and that is why the balance sheet balances. Now, this example from the Small Business Administration also provides a very helpful, simple cash flow statement. And in this case, it basically summarizes what we just discussed. So you can see that when they started out, they had no cash. Now, although it's not presented in chronological order, you can basically see that they invested $15 in the company, which was the equity that we saw. They borrowed $30 to get started. They also sold goods, and they collected on accounts receivable $20, and they also made cash sales of $31. So in summary, the business generated this much cash by, one, making sales in the form of cash and having people pay them back from accounts receivable. They borrowed $30, and they did an investment of $15. Now, they spent the money on equipment, the coffee maker. They had some other expenses, which we can assume maybe were salaries that were paid. They have inventory on hand of $33.80, so they bought inventory. And they maybe made a payment on their loan that they borrowed of $1, and as a result, they have $11.20, which, as you'll recall, basically ties to the cash that is on the current assets, and we can see the $15 in equity under the shareholders' equity, And we can see that they borrowed $30, but they paid back $1, which is why the notes payable is $29. So that is a very simple example of cash and monitoring all of the cash transactions that happen and how those show up on that balance sheet. Now, what's interesting in this scenario is the SBA did not provide on their website an income statement. But because of the relationship between those statements, I was actually able to prepare an income statement and see what happened. So I know that they generated $51 in sales because on the cash flow statement, I saw that they had cash sales of 31 and they received collections from accounts receivable of 20. So they had total sales of 51. I know that they incurred expenses of 26 because it says on the cash flow statement, expenses paid, 26. I know that they basically had a financing cost, of $1 because it said on the balance sheet there was depreciation of $1. So I know that they marked down their coffee maker by $1, and that is my operating profit of $24. Now you might be asking, well, why is this $1 not the $1 that was the principal payment listed on the cash flow statement? Because when you pay down on a loan, that is treated differently than a financing cost, because the financing cost, as you will recall from the income statement, is basically your interest on your principal, right? When you pay off your principal, you're basically paying down your loan, and that is not an expense. It is a use of cash, but it is not an expense. And as a result of that, I was able to basically pull together a simple income statement for what happened with this business, which I was able to share with you. So as we start to wrap up, I wanted to just kind of give you some thoughts to reflect on. You can use your financial statements to analyze your business. In addition to the importance of having them for other people who are going to ask for them, they're useful for you to analyze your own business. We talked earlier about a concept called cash burn. That is basically, I take the amount of cash that I have today and I divide it by my expenses over a week or over a month. The answer of that division will basically tell you how long can I keep my business going if I don't sell another product. Flipping that on its head, how much do I need to earn to keep going another week? That is why I view the cash flow statement again as the most important statement for a business owner. I also talked about gross margin, which is I take my gross profit and I divide it by my sales. That gives me a sense for how much value am I adding before my operating costs. Are my gross profit, less than my sales? Because if they are, then I know that my products are profitable. And I use the example I mentioned of the cocoa company to talk about or to explain why that is so important. The last one is a concept that finance people love, but it's also important for you as a business owner. And that concept is something that is referred to as return on equity, which is another way of basically saying, is my money making money? And you take your net income and you divide it by your shareholders' equity, and it will give you a sense of is my business a very good investment? So in other words, if I invest $10 in my business, and at the end of the year, my business generates $2 in profit, I know that my return on equity was 20%, 2 divided by 10. So I should feel pretty good that every dollar that I'm putting in, I'm making 20 cents on it, and hopefully I can repeat that and do it year over year until I get all of my money back. So it is essentially a return on your investment. I'd like to talk about where you can find help. So I recognize during these times that financial statements are not, preparing financial statements is an extra burden and it's an extra cost. But it's an important one, and it's one that you shouldn't skip over. There are many do-it-yourself online tools such as QuickBooks, FreshBooks, Pobly, Wave. They are reasonably priced. They require your effort to make them work for you, but they will help you be able to prepare basic financial statements. If your business is large enough and you don't feel comfortable doing it yourself, ask for recommendations from other business owners. And I underscore recommendation and the words good, because you want to work with good accountants, people who will help you understand your business and help you think strategically about your financial statements, including your tax statements, as you grow your business. I was on a workshop a couple of days ago, and the convener of the workshop basically emphasized over and over again the importance of not going for cheap when finding an accountant, but finding a good accountant who will actually give you good advice and do your work properly. I also would like to encourage you to look at the Small Business Administration Learning section. They have a number of tools there which cover financial statements, marketing your business, where to find financing, to allow you to dive into this topic, in more depth. So the bottom line is that there are lots of resources, available, including obviously even Invest Newark. Use them, because starting where we began, it is important that you have financial statements so that you can present your business and so that you can understand your business. Therefore, I will repeat one last time. You need to have financial statements. Don't skip preparing them. Financial statements will help you price your products accurately, know if you are making or losing money, whether that's in general or on specific jobs or products that you do, understand your cash flow in the short run and the long run, and it will let other people know how you're doing, such as in the United Way City of Newark grant application, or applying for PPP funds, or applying for the NJEDA grant. You will need statements to tell people how you're doing, which in summary means that it will allow you to compete for capital. Not having financial statements will cost you money, and it will cost you opportunities. And the last thing that I would like to do is a little bit of a plug for a company that the City of Newark has helped to finance the creation of. The City of Newark has helped support a very innovative employee-owned business that essentially provides office and janitorial products. There are currently 3 employee owners. They have warehouse, they have a product, they have the ability to offer you competitive prices for these products. So as you all think about your business, if you need office or janitorial products, or other businesses that need janitorial or office products, I would encourage you all to consider the Newark Paper Company. It's an employee-owned business based here in the City of Newark, and their details, are available. The employees of that company would really appreciate your help, and it will also help prove out, one of the city's economic initiatives is to helping to support employee-owned and the growth of employee-owned businesses. So thank you for allowing me to present that. Lastly, we'll conclude by just leaving up this slide, which will again kind of highlight to you resources that are available for COVID-19 impacted businesses on our website. And with that, you can also, we also have a business directory and a procurement portal. So please visit Invest Newark website for additional information. So we've concluded the presentation. We're right on time with about 20 minutes for Q&A. So I'm going to open up the chat forum first, and I'm going to try and answer a few of the questions on the chat forum, and then we will open up the microphone for everyone to be able to answer questions. So I see the first question is, what ratios should I be using as a good benchmark for my business? That is an excellent question. If you basically Google financial ratios for companies, I believe that NYU published a study that had important financial benchmarks for companies across different types of industries. And you can go as far as you want to go in terms of determining ratios based on the type of business that you have. But at a minimum, what I would be looking for are gross margin, which we covered earlier, operating profit margin, which we covered earlier, and return on equity. I also would look at leverage ratios if you have a bunch of debt or if you have a lot of debt. And a common ratio to look at for leverage is obviously the total debt versus your total assets, because there are situations where businesses have negative equity, so the total debt is actually more than the total asset because the shareholders' equity is negative. The other financial ratio that I think is good to look at is interest coverage, which is basically if I look at my operating profit and I divide that by my interest expense, that will give you a sense for your ability to pay off your interest. Now, what is important to do with these benchmarks is to compare them to businesses in your industry, which is why I mentioned the NYU study on ratios for businesses across industries. The second question that was posted online is, what recommendation would you give to someone who is not adept of math, would like to have a good understanding and not leave solely to accounting? What I would recommend is getting an online tool and beginning to just practice. Or you can also use Excel. And the easiest thing to do is to basically track your expenses daily. And what I mean by that, or not track your expenses, but basically track all of the transactions that occur in your business daily. And that literally means every time there is a transaction, writing down what occurred. How much sales did I make? How much did I spend on costs during the day? How much did I spend on utilities during the month? And you basically add up all of these numbers over time. And as you practice, you will begin to get good at understanding the basic concepts of tracking my cash inflows, tracking my cash outflows, and just having that knowledge will equip you so that when you have your accountant and you are discussing your financials, you will have some picture in your mind about, well, I know that these type of transactions happen, so this number looks reasonable to me, or it doesn't look unreasonable. And then the last thing is always to find friends that may be adept at that topic that you can discuss your business with. You know, business owners are very willing to have conversations with other business owners to basically discuss best practices and take a look at their numbers and their situation. So feel free to ask for help, feel free to practice, but I like the idea of making sure that if you feel like you're not strong at math, practicing or getting some other inputs so that you're not left solely to face, an accountant. The third question is, what qualities would I need to look for when searching for a good accountant? What kind of questions can I ask? I'll refer again to getting recommendations. I think one of the first questions to ask any accountant are, may I please have the name of some of the other businesses that you work with, and may I call them and ask for a reference? I always believe in getting references from good accountants. The second is, I believe that there are tools where you can check to see whether or not an accountant has the basic accreditation. So are they a certified public accountant? Are they in good standing with the the Association of Certified Public Accountants? Those are some easy tests that you can do to basically ensure that an accountant is good standing. But I also say to trust your gut. So if you ask an accountant for references and they're not willing to provide them to you, then I would encourage you to move on, because a good accountant should be very proud of the work that he does for his or her clients and be willing to give you, a recommendation. And then you can also even ask them questions such as, have you worked with other businesses similar to mine, and how have you helped them? I think those type of questions will help also inform, your gut. Question is, should I look for an accountant first or start with a bookkeeper? I view the two as one and the same. So I think if you are discerning a difference, then I recommend basically starting with the one that you feel most comfortable with and that you can relate with. But a good bookkeeper should be able to help you provide financial statements. What were those grant programs again? If you go to njeda.gov, you will read on their website that they are about to open a second wave of grant applications for businesses across the state of New Jersey, and I think those grants can range from $1,000 to $10,000. So with that, I think we should open the floor up to questions that may come from the floor, but if not, then I will keep going and I will answer questions such as that are remaining in the chat forum.
Hello, Mr.
Vanessa,
Robbins.
I'm going to stop the screen share and I'm going to hand it back over to you.
Hello, Mr. Robbins.
Yes, hello.
Yes, just a quick question. I'm a parent in the South Ward. This is Che Coulter. I just had a question about those.
Okay.
I had a question about those tools, how we can practice our banking sheets, our cash flow statements, and our expenses. You said that's on the small business website, so I will look there, and we appreciate you, and we just wanted to invite you, your agency, Invest Newark, back to the Trek Center once the pandemic is over, because y'all had an event at the Trek Center in the South Ward, and South Ward wants to welcome you back once everything opens back up.
We'd be glad to go back and speak with folks at the Trek Center. Just let us know in the presentation that'll be posted online. You can write our hotline address and you'll get a reply, but thank you for that invitation. We would welcome back.
Last thing, can you post the NYU study so that we can look at that in our free time? Thank you and God bless.
Yes, I will find that NYU study. It deals primarily with big companies on ratios, but I will find that and make it available. Other questions from the floor, or I can go back to the chat forum. Okay, so I'll go back to the question. Would it be best going forward for dividends or monthly salary in my business? There's no whether it's best or not. because it actually depends on what you're trying to do with your business. The most important concept that I believe that many small business owners overlook is the importance of paying themselves. So whether you pay yourself in the form of a dividend or you pay yourself in the form of salary, that is your personal choice. I would be inclined to pay myself in salary because that will basically help reduce the taxes that you have to pay for your business. However, there's multiple layers underneath that question, and it's worthwhile for you to talk to your accountant or your financial advisor and for the question to fit into your long-range plan. So the most important concept is you should always factor in the cost of paying yourself in your business, because many owners forget to pay themselves or factor their own costs in when determining the cost structure of their business. But how you choose to do that actually depends on your financial strategy. And as it relates to paying dividends, you can pay dividends, on whatever periodic basis that you want. Now, for minimizing tax costs, again, this has to fit into your financial strategy. And I'll make this general comment. Many small business owners organize their business in order to basically reduce the amount of taxes that they have to pay. Now, that might be a good decision if your objective is you only have this company, it's all that you want to do. You want to basically reduce the amount of legal expenses in order to
Ladell, we can't hear you.
Hello? Can you hear me now?
Yes, if you wouldn't mind repeating it, the last 2 minutes. Sorry, you were coming. It was crackling, and and then it dropped out.
Okay. I was basically talking about, and Vanessa, please let me know if you can't hear me. There was a question posted about minimizing tax costs. And I wanted to just make a general comment on this because it depends on the strategy for your business. And I'm giving 2 examples. The first example, if your sole ambition is to just have this small business and you run it basically to support your personal lifestyle, it is an acceptable strategy to look for all of the legally deductible costs that exist in order to manage your tax statements and financial statements such that you have to pay as little in taxes as possible. However, let's say your ambition is someday you want to sell your company to another party. In that case, another financial strategy you may choose to take is you want to show profitability in your business because you want to make it attractive for someone to buy. So when you think about your financial statements and particularly your tax statements, it is very good, it is wise to get help and to ensure those statements fit into your financial strategy. And I think that is the best way to answer that question because it really depends on what you are looking to do. Are there any other questions from the floor, or I will continue to answer questions from the chat forum? We have about 6 more minutes. Okay. So there's another question on the chat forum, which are, can this breakdown be sent through email? I would like to review the breakdown for assets divided by equity. The question, I'm not quite clear, but the presentation will certainly be made available. And I think the concept is you want to essentially look at the left side of the balance sheet, which is total assets, and you want to compare it to the right side of the balance sheet. Now, I think the ratio of assets to total equity is an unusual one that you see, but it does kind of answer the question of how are my assets funded? How much of it came from equity and how much of it came from debt? And I hope that everyone can hear me. Many thanks to the person who posted already on the chat forum the study that I mentioned from NYU, which has financial benchmarks across industries. Are management prepared statements acceptable to banks? As a general answer, no. The reason why is banks tend to want to have an independent person review your financial statements because they know that when they read something and it says management accounts, that basically means that the person who is giving me the information is the same one that provided the statements. Therefore, they could say anything. So you will find that banks tend to want to have statements that have at least been reviewed by an independent person. However, banks do have some discretion, but as a general answer, you'll find that management prepared statements are not viewed as highly as those ones that have been independently reviewed by a CPA to ensure that you're providing, honest information. Any other questions from the floor, or I think I may have missed a couple on the chat forum? Okay, I think we, in a roundabout way, covered the question that was put forward on deductibles. There was a question about what type of business entity would you advise to go for as a startup? Again, that depends on the business and your strategy. I think if I were starting a business, depending on the type of business, I would either go for a sole proprietorship, so basically a home-based business or a sole proprietorship that may be unincorporated, which I would essentially file along with my personal taxes. However, I would use a Schedule C when I'm doing my personal taxes to basically show the income that was generated by my business. However, if I am going to have to enter into contracts as a business, then I recommend that you set up a limited liability company. And the reason why is the limited liability company, even if it is a sole proprietorship, will provide protection between you as a person and the legal entity. So when you contract with a person or another business, it will be, Ladell Robbins Limited Liability Incorporated that is signing the contract so that there is a legal barrier between Ladell Robbins, the person, and Ladell Robbins, the legal entity. So depending on the type of business that you're about to set up, you could decide to just be a sole proprietor in a home-based business and be unincorporated, or you can decide to set up a limited liability company depending on your ambitions. So it all goes back to your business strategy. I think that basically uses all of our time, and I think we've covered the questions. So Vanessa, I'm going to hand it over to you to close out. Hello, Vanessa, are you there?
Yes, hello, sorry. Thank you again, Ladell, for your presentation. It was very helpful for everyone to learn about why they need their financial statements and what they can find out by creating their financial statements. As I mentioned earlier, this webinar was recorded, so we'll be posting it on Invest Newark's YouTube, and I will be sending the slides to everyone that registered. And we wish everyone to be well and be safe during these times. Please look to investnewark.org for any other support that you require for your business. Thank you.
Thanks, everyone. Have a good day.